It's Tuesday the 10th. Good morning, everybody. What are we talking about on today's show? Tech squeezing higher again. Keir Starmer, well, he keeps the keys to Downing Street for now. And it's a big morning for earnings. AstraZeneca and Barclays, they're breaking right now. Their CEOs are going to be on the show shortly, Anna.
Plenty to talk about when it comes to the earnings stories this morning, Guy. Treasury markets, bond markets looking largely calm. FX markets, yes, we see the yen on the move, but largely calm. So we've gone unashamedly all stocks in our data check this morning. So MSCI Asia Pacific doing pretty well through the Asia session. The tech lead from yesterday in the United States helping out the Asia trade overnight. We've seen strength coming through for global stocks, touching new highs for the global stock narrative. We will be moving on to talk about earnings with European futures and S&P futures looking flat to negative. We'll also be trying to turn the corner into some US data, of course, this week. The countdown to the opening trade starts right now.
Good morning. We will get to the earnings stories, of course, and break those down for you. But let's start, as we so often do, with the tech story, because we did see a revival. Futures, though, are pointing lower today when you look at the Nasdaq futures. Yesterday, the gains came through. IT sector was the best performing sector across the S&P 500. The Nasdaq 100 gained 0.8%. And Alphabet tapping the debt markets and massively oversubscribed, so issuing $20 billion worth of bonds. There was $100 billion worth of demand, and the yield was just less than 1% above what you get on US Treasuries. So Alphabet tapping that demand. They want to spend $185 billion. It's a reminder that the picks and shovels businesses will continue to be supportive, is the take from some, given the capital's coming through for these hyperscalers to spend on capex. Again, tech back, but futures looking a little fragile. So how much fragility is there in this modest revival?
It feels like it's the continuation of a squeeze that came out of Friday. That felt what yesterday's session maybe looked like. The Alphabet story is fascinating. Why are they doing it with the debt markets? Why don't they go to cash flow? What is it that they're signalling that they feel that they need to go to the debt market for this? I don't know, but it feels like a risk. There's an interesting note out this morning on that subject from Richard Windsor. But kind of back to
Why wouldn't they if they're only paying 95 basis points above Treasury?
Because at some point there's going to be a clear out, and at some point do you want to have a stronger balance sheet? At some point do you want to put your balance sheet at risk at this point? That debt is forever. Particularly, it's for the next 100 years, potentially. Do you want to have that around your neck, or do you want to have a clean balance sheet coming out of this?
Yeah, and part of the distinction many were making between now and the dot-com bubble was that this wasn't being done with debt, this was being done with cash. So anything that looks more debty maybe raises that particular alarm bell. But maybe we're far away from the bells actually ringing. Yes, 100-year bond really caught my eye. That's in sterling, interestingly. Yeah. And the idea of a 100-year bond in tech really amused me this morning. The idea, where on earth will the tech story be in 100 years? Seems impossible to define.
Where was it 100 years ago?
Exactly. Well, it was aircraft and cars and telephones. Yeah. So that gives you a sense of history on the move. But I was actually, it's not like me to play Team Doomster, but that was where I was feeling yesterday when I was watching some of those insurance companies in the United States. And we might see some of this in Europe today. So away from the big positive tech story we saw in the US yesterday, some of those insurance brokers were negative on the back of the AI threat. And this is kind of a sequel to the legal services story, to the financial services analyst story that we were talking so much about last week, the software story coming
there's a couple of sides to this, isn't it? Because insurers are in focus because the expectation is that with the potential 100 billion or 100-year debt sale from Alphabet, that's going to be priced in sterling, because they want the insurers and the pension funds here to pick that up because they see there's demand there for it. Yep. But you're right. Look, this is a reminder in terms of the AI volatility. We are going to continue to get this volatility because these large language models and the others in the tech space are going to continue to develop and put out tools that are going to disrupt, and we have to brace for that. And that is another reminder as we focus on the insurers today.
One final thought before the producer tells me I have to move on, which has already happened. Trump says that we're going to get 15% growth in the US economy. Why wouldn't you buy mid and small caps? Why would you buy tech? If growth is going to be easy to come by, 15%, why do you need growth stocks? You don't. You need small and mid cap stocks.
I'd put a small question mark over that 50%.
I appreciate that.
Usually takes a pandemic or a war to deliver that for the US economy.
Let's hope that's not coming.
We'll leave that thought there. Let's talk about the other topics on our agenda today. And one of them, of course, is UK politics. Keir Starmer, the Prime Minister, he survives for now, which is the addendum that everybody makes to that sentence. What a dramatic day. Scottish Labour then calling for his resignation. We saw the gilt yields rise as we were approaching that press conference from Anas Sarwar. He called for his resignation. We we were all bracing to see whether other names would jump into the fray. And then one by one, the cabinet members decided to back him, or came out backing him at least. And then bond market yields dropped back. So, that was the story of one day. But what happens in the run-up to May? What happens after May if the Labour Party does as badly as some people anticipate?
This is the whole theory, is why go now? Like, why would you hang the May elections round whoever is going to take over next? Can we park this till May? It feels like we probably can. Nobody in the Labour Party wants to make a move until May, unless things get really bad. So can we put this to one side until we get to May?
Doesn't it also partly depend on what HMRC does with Angela Rayner and her tax affairs? If HMRC can sort that out, Angela Rayner has that power base, and she becomes a real contender. So there's a time frame in terms of when that gets arranged and sorted.
Sure, but why would she want to do it before May? Why wouldn't you do it after May? Yes, she came out and backed him yesterday, and the tax story is important, but wouldn't she just wait until after May?
We have a nice story out this morning talking about some of the very green shoots, I'll say it quietly, in the UK economy. And maybe you also want to wait a little while to see if those take root further. I'm not sure my metaphor around green shoots is really working there, but that's part of the narrative. Shall we go to the earnings stories this morning, because we have some of those coming through? Do we start with Kering? Do we start with BP? Where do we go first?
Let's start with BP. So this had been flagged by the analysts that they may cancel the buyback programs ahead of Meg O'Neill taking over as CEO of this business. Of course, the stock is up about 10% in the last 12 months. The redhead across the terminal right now is that indeed the buybacks will be suspended. They're going to proceed from divestments now of about 11 billion. They have decided to suspend those share buybacks. That had been expected. That's been confirmed now. The redhead, BP, raising its structural cost cut target to between $5.5 billion to $6.5 billion by the end of 2027. So they're raising their structural cost cutting target up to $6.5 billion by the end of 2027. So we're looking for more details on that. They're targeting $20 billion of divestments by the end of 2027, which seems pretty significant. So those are some of the key lines coming through from BP with the earnings out this morning.
Quite a lot of news in there, and actually promises in there, given that they are about to have a new CEO. Let's go to AstraZeneca. Fourth quarter core EPS coming in at $2.12. That's actually a touch below the estimate of $2.14. So we'll certainly be looking for further details on that from the CEO when we speak to him a little bit later. The focus was going to be on the guidance, though. So we'll certainly be looking at the full year guidance here. They're now saying 2026 core EPS up by low double-digit %, revenue up by mid to high single-digit %. Is that low ball? Will there be an opportunity to come in stronger than those numbers? US pricing, plenty of big themes to talk about when it comes to the drug sector.
OK, let's get to Barclays, figure out what is happening. We're about to talk to Venkat, so let's just go through the numbers quickly. Capital returns greater than 15 billion in the years 26 to 28, on track to deliver 26 targets. Net interest income 3.73, estimate there 3.76. The investment bank has done well. Looks like it's beaten targets. The numbers pretty much in line with what certainly everybody was expecting. CS Venkatakrishnan, the CEO of Barclays, joins us now. Good morning, Venkat. Happy with the numbers? Is this a change of strategy? You're kind of pushing forward in terms of the return that you're going to give to shareholders, but it feels like a continuation of the strategy that you outlined a couple of years ago. Is that the right way of thinking about this?
First of all, I'm very pleased with the numbers. Thank you for having me. Our top line is 29.1 billion, which is 9% higher than it was a year ago. Our bottom line, 9.1 billion pounds profit, which is, again, 13% higher than it was a year ago. And all parts of the bank, including the investment bank, firing on all cylinders, ROT of 11.3%, and capital distribution of 3.7 billion pounds compared to 3 billion a year ago. The new strategy is about acceleration of what we've been doing. So higher returns targets, 14% by 2028 or above that, and 15 billion pounds of capital distributions, more than 15 billion by 2028. So it's an acceleration of what we've been doing.
Which bit of the business is accelerating, Venkat?
So I'm very happy they're all doing well. And, each of the businesses produced double-digit ROTEs in the last year, and we're expecting them to continue. The strongest performing parts have been the ones that have come from the furthest behind, which is our U.S. consumer bank, which has gone from 7% to 11%, and our investment bank, which has also gone up by 400 basis points in the last few years. So those are accelerating. They're doing well. The rest of the businesses are at high teens, 20s. And what we're expecting to do is to build segment-leading businesses, connected strongly to each other, and we're investing deeply in technology. We're really going to start powering this bank now.
Venkat, good morning. We certainly want to get your views on AI and tech, but before we get there, you mentioned the US. What are your priorities for doubling down on the US business and how you compete with the big 5 US lenders? What particularly and specifically will you be focused on?
Yeah, so if you look at our US consumer bank, it's essentially a completely digital footprint. We have no branches. We have a digital deposit capability. We are one of the largest partner card offerers in the country. And now we've bought a company called Best Egg, which is a leading direct-to-consumer loan platform, also digital. So look for us to stitch these things, work together with our partners, and deliver lending and banking in the US digitally. That's how we will compete. It's a disruptive model.
And you think you can rival, you think you can compete in terms of the investment banking business with your US rivals?
Well, we already are competing very successfully in investment banking with our US rivals. You know, Barclays is the largest non-US investment bank. And just given our footprint, there are many sectors, especially fixed income and credit, where we are very, very competitive with the top 5. And that has always been the calling card of Barclays. Our prime financing business in equities, I'm standing on the equities floor, is top 5. And so we are extremely competitive, and we look to deepen and broaden that competition, not just in the US, but across the world.
Good morning to you, Venkat. You talked a moment ago, temptingly, about investing deeply in technology. You talked about the way you want to be disruptive in the US, stitching models together and keeping that digital presence. But what difference does the AI push more broadly, globally, maybe more in the UK? What difference does the AI push make to the way you run and operate Barclays?
So as you can see, when you look behind me, this is an entirely electronic operation. And what AI will do is give us 2 forms of productivity. One is it will make coding, model development, and all sorts of existing manual processes much more automated and intelligently automated. The second thing is once you've got that efficiency, it allows you deeply to personalize your services. We're already doing that on our FX trading floors using chatbots to serve our clients. We're doing this in consumer service and customer service in our US cards business. So look for that deep personalization in financial services. That's the future promise of AI, and we need to realize that. We plan to do that at Barclays.
And what does this mean for white-collar jobs? There's a lot of nervousness in the city, no doubt, about this theme, Venkat, but also in all kinds of sectors. We're just coming to grips with who the winners and the losers are from AI. What's your expectation there?
Look, there's obviously a productivity element and an efficiency element, but I'm looking much beyond this. I think it's really important as corporate leaders for us to create the right working environment for our colleagues, equip them with the newest technologies, and allow them to be more productive. Done right, this creates efficiency, but efficiency in order to produce better products, design better capabilities, and deliver them better. That is the next frontier, and that's what we have to be focused on.
Venkat, what does the banking sector in the UK, what does Barclays want from the next Prime Minister?
Well, what we want from all governments in the UK is a commitment to growth and productivity. We think the markets look for stability in financial policy and economic policy, and you can see that in the way the markets are trading. And so what we look for is stability, predictability, and policies that drive growth and support business and industry, and from my point of view, the financial industry.
And thinking about the financial industry, Venkat, I wonder if you're anticipating further regulation of the relationships between the financial services industry and government. We're watching, of course, the fallout politically from the Epstein revelations, Peter Mandelson revelations here in UK politics. I wonder, and the Bank of England governor has talked about a lot of soul searching for the financial services sector about how things happened that happened many, many years ago. I wonder if you're anticipating further regulation around lobbying.
Look, I find the articles deeply, deeply dismaying. The moral depravity and the corruption are just stunning. My heart goes out to all the victims of the scandal.
Venkat, when we look at switching to your kind of feel and your finger on the pulse of the UK economy, the BOE is looking at growth of 0.9% in 2026. Does that align with your view? How is the UK economy looking? What is your expectation right now? Are you seeing green shoots?
Look, well, we had a good retail sales number this morning, which may be a green shoot in the middle of February. But I think broadly the UK is a 1.5% economy. So it aligns with our expectations. I think for the long term, we really need to invest in growth and we need to invest in productivity. And AI and technology holds a promise for productivity, which the country and every part of the country, every industry needs to seize. We are certainly planning to do that at Barclays.
OK, Venkat, thank you very much for your time on the back of those earnings. Of course, CS Venkatakrishnan, CEO of Barclays. Staying with banking, Standard Chartered CFO Diego De Giorgia has resigned to take up a role with Apollo Global Management. De Giorgi had joined the lender in 2023 and was seen as one of the front runners to eventually replace longtime CEO Bill Winters. He's going to move to Apollo as a partner and head of Europe, the Middle East and Africa. Standard Chartered says Deputy CFO Peter Burrell will replace De Giorgi on an interim basis as the firm seeks a permanent replacement. For a stock to watch this morning.
Yeah, absolutely. Yeah, Bloomberg recently spent quite a lot of time with him with the CFO show. Still, coming up on the programme, we will bring you more detail on one of today's biggest European earnings stories. AstraZeneca CEO Pascal Soriot will be with us to discuss all things pharma, US pricing, growth, oncology perhaps, certainly obesity drugs will get a mention. Plus, we will cover the luxury sector after Kering reports Gucci sales tumbling in the fourth quarter, albeit in line with estimates. Up next, we'll dive into markets with our MLIV team and take a look at the US as President Trump says his Fed chair nominee Kevin Warsh can stoke the economy to grow by an incredible 15%. If you have questions, if you want to get involved in any of these conversations, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
Welcome back. We are about 40 minutes then from the opening trade this Tuesday. European futures pointed to gains of 0.1%, with the context, of course, that we got fresh record highs for European stocks yesterday. US futures slightly negative on the Nasdaq 100, down 0.1% after a strong session yesterday. It's been very strong over in Asia, particularly pronounced over in Japan, with the Nikkei up 2.3%, Anna.
Yeah, absolutely. New highs for global stocks. Let's talk about the markets then with our Markets Live executive editor, Mark Gardmore, who joins us now for 3 minutes on these markets. Mark, let's start with the clues you're getting about global growth from various asset classes. Stocks seem to be trading with enthusiasm for a growth narrative. President Trump is talking about 15% growth. Are we getting all those clues consistently from all asset classes?
No, Anna, I'm super confused by the price action this morning. I think the news flow this week was very negative for long-end bonds. Not just the Taikechi election victory, but of course we have political problems in the UK. We have the fact that, Trump's talking about Warsh, getting growth up to 15%. We have the AI corporates continuing to kind of go on a debt binge. Everything should have pointed to kind of higher yields, and yet bonds are trading tremendously well all around the world. Now, normally you'd get that scenario if people are saying, hey, I'd love to lock in yields at these levels, long-term yields at these levels. It's about the long duration bonds that I'm worried about, which would imply that they kind of think that we're going into a negative growth situation where we're going to have to cut rates significantly. That doesn't make sense, and it's not tallying with all these other assets out there, like stocks that are trading pretty positively. So to me, there's something weird about how the price action is this week. I don't think it's sustainable. I don't have high conviction about which way it breaks. My bias, which is, I'm warning this because it's dangerous to lean into your bias, my bias at the start of the week was that bonds should be weaker, yields should be higher, which is the bit that's going wrong. So I'm on the back foot right now, so you probably shouldn't listen to me at all.
Always listen to you, Mark. Of course we do. Stocks yesterday, still squeezy? Is this still a continuation of the squeeze? Big squeezes tend to be quite negative.
Yeah, look, absolutely. You get the most powerful rallies, short-term rallies in bear markets. That's absolutely the case. I think that the price action there is still kind of relatively fragile. My narrative for the week was that we had all these reasons for yields to go higher, and then that would be the next catalyst to kind of knock stocks for another bit of a broader kind of washout. We're not really seeing that yet, so I'm a little bit confused. If yields continue to trade like this, it's very supportive, and so maybe we continue to consolidate in stocks for a while. I don't think we roar away to the top side. As you know, my structural view for 2026 is quite positive, is quite bullish, but I'm just quite worried about the short-term price action, and that's not gone away. Which way we break right now, I really don't know. If I'm forced to choose, I still think we break with a little bit more of a washout in the momentum trades, the meme kind of trades. I still think crypto, precious metals, some of the tech names are trading in a not great way despite some of the power of the rallies.
Yeah, Bitcoin down again today, to your point. Mark, do you have conviction around the rotation trade and the diversification we're seeing? Again, the outperformance of Europe yesterday.
Yeah, I think the diversification trade makes sense. You know, I'm the person who always falls for every value trap. And as you know, I've talked for a long time about US stocks, you know, will underperform because the rest of the world will outperform because they're kind of cheaper. It's that value play. We move away from the tech space. So I kind of believe in that. It's gone a long, long way now, which kind of worries me. Small caps, for example, in the US can't drag the stock market forever. I think some of the indiscriminate targeting of the software space has gone overboard. I think some names in software should suffer by what's happening in AI, but not all of them. So I think that, you know, the rotation as a fundamental theory makes sense. It's probably gone too far, which maybe sums up a lot of how I'm thinking about markets at the moment.
Mr. Mark Cudmore, thank you very much indeed, sir. Bloomberg Markets Live executive editor. You want to get Mark's view, you want to get the rest of the team's view. They're not always aligned. Sometimes they are, sometimes they're not. It's always interesting when they're not. You can go to MLIV Go on your Bloomberg terminal. What else you need to know this, Tuesday morning? The White House says the exact date in April for President Trump to meet with the Chinese leader, Xi Jinping, not yet actually been finalised. This after Politico reported that Trump would head to Beijing to meet Xi in the first week of April. The report says the two leaders could potentially meet 4 times this year as their trade truce continues to hold. The European Union is preparing options to embed Ukraine's membership in a future peace deal. That includes providing Kyiv with protection and access to membership rights. The bloc would give Ukraine a clear time frame of steps to advance with the formal process. Other options including continuing along existing accession paths or introducing a transition period. And get this, the Bank of France governor, Francois Villeroy, has announced that he is going to step down in June. Now, this is well before his term is due to end in October 2027. Why? Now, Villeroy says the decision is personal. However, this is the interesting bit, it clears the way for President Emmanuel Macron to appoint his successor, rather than leaving that choice to a future administration post-2027. This feels like the French state is getting a little nervous to me.
Well, it does look as if maybe taking lessons from global central banking, you might ask questions about how you shore up long-term stability at a central bank and try to remove the ability for politicians to influence it in the very short term.
So this is the ripple effects of what's happening with the Fed.
Maybe.
And you're starting to see that in the UK as well with Nigel Farage. Well, possibly, right?
Potentially,
like central bank
maybe that's the inspiration. If that reporting is
it's trying to make sure that Le Pen doesn't get her arms around the French central bank, which is basically what you're saying. But they're trying to Le Pen proof the Bank of France, which is an amazing thing to try and do.
Yeah. Well, and as we say, maybe taking lessons from what we've seen in other geographies.
Yeah, Nigel Farage, who could be the next Prime Minister on current polling, has said that he would not rule out removing the Bank of England governor. Coming up, we're going to get back to the earnings story. AstraZeneca expecting profit to grow further this year, driven by sales of its cancer drugs. We're going to get the CEO on to discuss. This is Bloomberg.
Welcome back to the programme. This is the opening trade. 30 minutes until the start of cash equities trading. Let's have a look at the equity market futures picture. A lot of earnings coming through this morning, and we have started to price some of that in, perhaps. The futures picture actually looking a little more positive than it did just half an hour ago. It's turned green, not by a huge amount. US futures are pretty flat. The Asia session, Tom, very much buoyed by yesterday's tech enthusiasm in the States. That filtered through into the Asia trading day, pushed global stocks to a new all-time high.
Yeah, some big debt issuance, of course, coming through from the likes of Alphabet. very well received by the markets. On the sovereign debt front, you're seeing a bit of a bid when it comes through for JGBs over, of course, in Japan, US Treasuries, and here in Europe as well. Checking in on sovereigns here. German debt, you're seeing yields down about 1 basis point on the German 10-year. Over in Italy, basis point move of about 1 basis point lower on BTPs as well on the 10-year. So some money moving in to sovereign debt in Europe, and of course we'll be watching gilts. They've been a little bit active on the back of the political uncertainty here in the UK at 8 a.m. UK time. But so far, a little bit of money moving into the sovereign debt of Europe.
Let's talk about AstraZeneca.
Yeah.
Numbers out this morning. UK listed, now US listed as well. Worth noting. Q4 EPS on the estimates. This is the Q4 number. Looks a little light, but we'll park that one for now. Get a bit of variation in the numbers. Pascal's sitting next to me, so I'm being nice about this. The Q4 number looks good. Further growth this year lifted by cancer drugs. The oncology area continues to be strong. 26 revenue up by mid to single percentages. Core EPS up by low double-digit percentages this year. Pascal Soriot is the CEO of AstraZeneca. He's kindly joined us this morning. It's really nice to see you here in the studio.
Good morning. Always good to be here.
So this is what everybody was expecting coming into the numbers. Exactly what you delivered here. Okay, so this looks pretty much in line with expectations. But the expectations are also that we get halfway through the year and you raise your numbers. That this is conservative guidance. And that you're going to give us better numbers halfway through the year.
It's a good question, Guy. We always, of course, try to do better, but the key is really to stay on track with our ambition to reach $80 billion by 2030.
And you're on track with that?
And we are on track.
Okay.
And to deliver our pipeline. We had tremendous results, pipeline results this year. We have this year another 20 readouts, phase 3 readouts. We have 100 phase 3 projects.
Yep.
So it shows you the pipeline is moving, enormous level of innovation for patients in cancer and cardiovascular disease, respiratory disease, rare disease, and we stay focused on that.
So better things are still to come?
Better things to come, yes.
Okay.
Definitely.
And that's going to show up in the numbers? Maybe this year?
I think, again, if we deliver our guidance, we will be very happy. That's what we focus on.
What would make you very happy?
If we can do better, we will, of course, do better.
I can ask you about the weight management drugs and obesity drugs. Good morning to you, Pascal. You clearly are operating in this space. Do you need to do more deals in the weight management space? You've done the deal with CSPC. I wonder how that fits into M&A plans, if you have them more broadly.
Yeah, it's a great question. I mean, if you look at weight loss or weight management, this is a market that is not yet mature. It's evolving. And the products that exist today are great products, but we need to improve. We need to improve the compliance. So instead of weekly, moving to monthly regimens to make it easier for patients. Launch oral drugs, and Lilly, of course, is starting with that. And we are moving our oral GLP-1 into phase 3 already, so we're moving at speed. And then finally, we need to improve in terms of mechanisms. As you know very well, people lose fat, but they also lose muscle.
Yes.
We need to move to a stage where we will help people lose fat but less muscle, so the quality of weight loss improves.
Okay, and on that subject, yes, you've moved your GLP-1s to late-stage trials. When do you anticipate then that we get some data so that you're able to take this to the next stage and to launch? We
will present our phase 2 results at a congress this year. In fact, I think it's now public. It will be the ADA in the US, the American Diabetes Association. We'll have data in diabetes patients and data in weight loss.
That's stage 2.
That's our phase 2. Yeah. And then phase 3, of course, we will move that as quickly as we can. Our diabetes results will come first because you just look at glucose in the blood as opposed to measuring weight loss over a period of time. But we're moving as quickly as we can. And to go back to your question, we don't need new deals because today we may do deals in the early phase, discovery phase, but we really have a large portfolio covering all aspects of weight loss.
Yeah, and no, you don't have the visibility to say when we get the stage 3 results then and when launch
We
comes.
actually give guidance to the market, but we don't give specific dates, yeah.
What's your strategy? Good morning. What's your strategy for dealing with the compounders who look to sell kind of knock-off cheap variations of those obesity drugs?
Well, as you probably saw, they have decided to withdraw their compounded products, and the FDA is looking at it very seriously. Our strategy is to develop better products than those products that are on the market, including the compounded products. But I don't think they have really long-term survival in the market. I mean, you can't compound products and break patents. But soon enough, traditional GLP ones will lose patent protection. So you'll have generics, biosimilars on the market. So again, goes back to improving the offer to patients in compliance terms, but also in quality of weight loss terms.
The US, obviously a massive market for these weight loss management drugs. What is factored in terms of the margins for the business on those price agreements and the drug price agreements with the Trump administration?
Well, I think
how much has been? Is there further squeeze on margins to come through as a result of that?
I think it's fair to assume the prices will continue to be under pressure. But then you have to assume the need is enormous, not only in the US, but globally. And as prices drop, and if we manage to deliver products at a lower cost of production, like oral agent, like our oral product, then we can actually deliver these products to the whole world. And if you look at Farxiga, our products for diabetes, kidney disease, heart disease, most of our sales, the great majority of our sales come from outside the US and outside of Europe. So, of course, we often forget the majority of the world lives outside the US and Europe. And a lot of these people need our products. So dropping price but expanding volume will certainly be our strategy.
Just coming back to within those markets, is the UK paying enough for drugs now? Is it going to continue to pay enough for drugs?
I think what the UK government has announced is a very good first step. But we continue working with the government to see how that will be implemented, because we don't know yet the details of that. But also it's a first step. We need to go beyond that because, the new products in particular will clearly be benchmarked to US prices. So US prices will come down, there's no doubt. But European prices have to come up a little bit in the UK and the rest of Europe.
And how much visibility do you have now, Pascal, around the US market and the pricing there? There have been lots of agreements signed, of course. Does that make you confident that the administration doesn't come back for more from the sector?
I don't think so, no, because I think what the administration wanted to do was to rebalance who pays for the cost of innovation and the risk. People forget the risk associated with innovation. We spend billions of dollars and sometimes products don't work. So they wanted to do this, but they didn't want to destroy the industry. They realized the US has is a key player in biopharmaceuticals. So I think now we have an agreement that addresses the president's goals, reducing the cost of pharmaceuticals for Americans over a period of time, but protects the industry.
What's the scale of that rebalance between Europe and the US?
Well, I mean, first of all, there's an immediate effect on so-called Medicaid. Medicaid is the insurance for the poorer people in America. And so we will give immediate rebates this year, aligning prices in the US to European prices. And then for new products, it will be prospective as they get launched. So we have said before, it will be an impact this year and moving forward, but we can manage it,
Pascal, what would a leadership battle at the head of the governing Labour Party mean for business investment in the UK?
Well, I mean, we hope that any government in the UK will work towards the good of this economy and the people in this country. So, I've been, as you probably know, I've been in this job for more than 10 years now, and I've worked with many different governments. And our message has always been, we have a tremendous opportunity in this country. Fantastic academic science, great universities. We need to transform this in economic value. First of all, products for patients, of course, but also economic value, which is the missing link. To do this, you need to invest in innovation to show companies that...
Are you worried about political instability here?
Political instability doesn't help, that's for sure, because, you want a government that is focused on the key priorities, delivering for people in this country, but also growing the economy. And political instability always creates, diversion, and it's not positive for anybody. Just like instability in a company is not very good either.
You've been there for 10 years, lots of stability at AstraZeneca. Can I just come back to the numbers? It looks like the stock is cooled a little softer this morning, and the reason for that is the revenue guide is seen as being light. What do you say to investors this morning if they see the stock marked down a little bit because the revenue guide is a little bit light? Do you have any kind of good news for them?
I don't think the revenue guidance is actually light. I think the market expected mid-single digit, and we delivered. Well, we delivered. We are announcing we're guiding for mid to high single digits, so it's in line with expectations, possibly better than expectations. And the important piece, as I said before, we are very much on track to the 80 billion by 2030.
Do you think there was a hope that maybe you give a little bit more? Do you think that given what you're doing, given what the business is doing at the moment, isn't there just hope that there could be a little bit?
We're also facing challenges. We're losing patent protection on Farxiga in the US this year. We have the same in China, so we have to manage those patent expiries. But the trend is good. We are very much on track. And as I said, the guidance is what we believe we can do. But over time, as the year unfolds, we may be able to deliver more, and we will go for more.
Because you've mentioned that $80 billion sales target for 2030. Is there scope to raise that?
Well, that's what people keep asking us, but the reality
it's a nice round number.
When we announced it back in 2024, in May 24, the guidance was the consensus, was 67 billion, and people said, "Oh, your 80 billion is a bit difficult to achieve. We don't believe it." Now people say, "Well, you can exceed it." We continue to believe it is an ambitious goal. And the important piece is we keep making progress. Look, when we announced May 24 this goal, we had 12 blockbusters, which are products with $1 billion sales or more. Today we have 16, and we plan to have 25 by 2030. And many of these additional 9s have delivered data already. They are in the regulatory process, or they are in phase 3. So we are on track, and as I said, we always work to do as well as best as we can. Right?
Yeah, it's amazing. The 80 is now consensus. People believe you. So they're now, as ever, more. It's always the case. Pascal, so great to see you. Thanks for stopping by to see us.
Thanks for having me.
We always appreciate it. Pascal Soriot, the CEO of AstraZeneca. Let's turn back to the growth story in the United States. The pressure to boost the US economy keeps picking up for President Trump's choice over at the Federal Reserve.
We should be at 15%. I'll tell you, if our new head of the Fed, who I think is going to be great, and he's a really high quality person, but if he does the job that he's capable, we can grow at 15%. I think more than that.
15%, that's a very big number. Donald Trump on Fox News talking to Kudlow, talking about the benefits of what he sees coming through from the new Fed. Is that going to benefit small caps? Is that the trade, if you believe you're going to get 15%? What kind of inflation number would you get with that as well? So many questions around this. More on the US economy a little later in the programme. This is Bloomberg.
I think the main message I want to leave you with is these markets, whether we're talking oil, metals, all of the old economy is substantially underinvested.
That was Jeff Currie, Carlyle Group Chief Strategy Officer. Meanwhile, African mining ministers and industry executives are descending on Cape Town this week for the continent's biggest natural resources conference. Africa Mining Indaba has emerged as a major battleground for influence over critical minerals. Let's bring in Bloomberg Chief Africa Correspondent and anchor Jennifer Dabasaja, who is standing by with a guest. Jen.
Yeah, that's right, Tom. And we've actually seen mining Indaba growing. This is the biggest Indaba that we've seen over the past few years. And I'm actually standing by with British Robinson, who is the Milken Institute Africa Chair. She's also been here at mining Indaba in different capacities over the past few years. British, great to have you here. Thanks for being here. We've been talking quite a bit about this boom cycle that we're seeing for commodities, but you and the Milken Institute actually believe there's a bit of a misalignment when it comes to the financial architecture and the capital that's needed for the mining sector. If we just start there, where do you begin rewiring this?
Yeah, well, thank you for being here. It's wonderful to be back at Mining Indaba. I think this year is a very special year. And speaking around the mismatch is that essentially there's so much world demand, significant world demand, but we haven't done enough exploration. And so one is that you need funding across the entire continuum of the critical minerals value chain or continuum. And part of that means that we have to look at investments, we have to look at partners at scale. It's going to require different partners and different types of investment. innovative investments. So things like certain vehicles, large-scale vehicles and funds in order to actually invest in the needs across the continuum.
Right.
Specifically, I think we're looking at everything from philanthropic dollars to family offices being able to join in the opportunity, all the way to multilateral corporations, all the way to companies, et cetera. And so that's what's exciting. I think you're seeing the U.S. government here in full force. We're very excited to see that because they're truly engaging in new ways. But what really excites us is seeing African investment. So what we call local capital.
Right.
From everything from African sovereign wealth funds to African pension funds, but in particular AFC, the Africa Finance Corporation, and others.
Well, British, you mentioned the U.S. government just a few days ago, the Trump administration announcing this $12 billion stockpile for critical minerals. What is that indicative of in terms of the investment potentially that the private sector is going to bring into the sector?
Sure. Well, first and foremost, I think it's indicative of the United States recognizing that we are dependent on Africa and that we have to price that dependency. And I think the stockpile endeavor with the U.S. EXIM shows us that we're willing and able to price that dependency, and that there's so much world demand from everything from batteries to EVs to electric vehicles to data centers that we can't sit on the sidelines, that we have to actively engage. And that announcement is the U.S. government's way of actively engaging in investing in these critical minerals that are going to be critical not only for Africa, but also for the world and ultimately for the United States. So we don't have a lot of details on it, but we're very excited that the idea, that the concept has been developed. That actually is an innovative way of financing the needs that are upon us.
How does that shape up, though, with what has been really a state-backed effort by the Chinese government to really dominate this mining sector, which we talk about quite often? How do you think not just the U.S. but also other governments then compete on this front?
Right. Well, I think it's going to take all efforts, right? So I think given the demand is so exponential that you need everyone to come in. I think governments have to choose how they're going to play and the way they're going to play. I think when you see special purpose vehicles, when you see announcements with supporting sort of mining all the way from the continuum, that in that sense that it's not about a competition, it's not about who's going to win and lose, but you have to get in the game. And I think that's the benefit of seeing some of these recent announcements with the U.S. government. You have here now the U.S. DFC, the U.S. EXIM Bank, the U.S. TDA. Right. So that tells you right away how significant our interests are, but also to bring alongside other investors. So it's not just government dollars, but we're now seeing, as I said, family offices, institutional investors, and commercial banks getting into the game. And that's actually what you need because it's such a long-term play.
Sure.
Right? So you're looking at 7 to 20 years. You need investors all along the continuum. And it's a mismatch because we were only seeing investment in certain places heretofore, and now we're seeing it along the entire continuum.
What does that mean, though, for the capital markets, though, and the investment that we have seen traditionally from the capital markets into the sector?
So the investments from the capital markets have been small for Africa. So while other countries have enjoyed fuller participation of investments, Africa still hasn't. The capital has sat on the sidelines.
In the mining sector?
In the mining sector. In many sectors, because Africa pays a risk premium. What's wonderful about this moment in time, in this current Indaba, is that we're seeing the capital markets stand up, take notice, and say, wait a minute, we may not want to invest across the entire continuum, but there are places where we think we can invest that make sense. The other piece I think is really important. You cannot do critical minerals without water and without energy, without ports, rails, and roads. Infrastructure. Folks, if they don't want to invest in critical minerals, can actually invest in infrastructure. Absolutely critical to critical minerals, right? So infrastructure, a little fact that's very important. If you're an investor, you want to invest in infrastructure, year over year for the last 10 years, returns on infrastructure investment in Africa is 8 to 10%, all the way up to 11, 12, 13%, with a default rate of less than 1%, which is measured, it's a AAA measure security.
So is that
so you can't beat it.
Are you advising your clients then
Absolutely.
in that sense and other governments?
It's a best bet.
What are the questions then that they're still asking you?
People are still asking about risk, and risk is important because we can de-risk risk now through Africa Financial Corporation through the AFC. We can de-risk through the US DFC. We can de-risk through Exim. So now we have instruments that are going to do that first loss or do that guarantee or do that local hedging around currency issues that's going to make it safer for investors, but also make them feel more uncomfortable. And I think that's what the news is today, is that now that hedging, that de-risking is available where it wasn't fully available heretofore.
British Robinson, great to have you here. Milken Institute Africa Chair joining us here at Mining Indaba. I'll send it back to you guys.
Thank you.
Jen, thank you very much indeed. Let's get back to what's happening in terms of the debt sales coming through from Alphabet. We talked about the fact that they had a successful sale of $20 billion in terms of US dollar bond sale, which was oversubscribed. Now a redhead across the terminal. They have started selling a multi-tranche debut of a Swiss franc bond. This is in maturities of 3, 6, 10, 15 and 25-year bonds, expected to price later today. So we watched that on reports that they're looking potentially at a 100-year bond in sterling, Anna.
Yeah, absolutely. Diversifying their FX over at Alphabet and debt it's in. Let's just mention a few of the stocks, Guy, that are going to be on the move. Kering could be higher over in Paris. The London market could be divided by Barclays going higher, but BP going lower on the back of some of the earnings stories that we've had.
Looks like Astra could be a little softer as well, not by much, but maybe just a touch lower in terms of maybe what the guidance has looked like driving that move down. You also got Philips out this morning. There's a number of there's lots of other numbers out this morning. It's going to be interesting to see whether we get a few surprises on any of these data points.
Yeah, absolutely. The Philips share price have certainly seen the expectations that goes higher. Right, we'll be back with the market open. Futures are pointing higher as we start to factor in some of these earnings stories this morning. This is Bloomberg.
Tuesday morning, good morning. Less than 2 minutes to go until the start of cash trading here in Europe. Let's have a quick recap as to what yesterday's session looked like over in the United States. Monday's session felt like, and look at this, it felt like a bit of a sort of extension of the squeeze. And let me just show you the evidence for this. Friday, obviously, we had a very strong session. Big squeeze higher, maybe some short covering coming through. Front end of the session yesterday, first kind of few hours of the session yesterday in the States, kind of felt like a continuation of that. What happened after that, I think, is really interesting. What we got after that was basically an incredibly tight range. And you can see that basically persisting towards the end of the session. So this feels like maybe Friday. This is the Monday session, a kind of holding action. Where do we go from here? Well, maybe a little bit more caution starting to creep in, but Europe's not quite there yet, Tom.
Yeah, the Mag 7 stocks have been flatlining. That rotation trade continues. European stocks getting those record highs again yesterday. And looking to build on that, yes, we've been talking about the divergent picture when it comes to the earnings story, and we'll give you the granularity on that in the next minute or so. But European stock futures pointed to modest gains of 0.1%, again, in the context of record highs yesterday. FTSE 100 futures up 0.2%. It was Basic Resources that laid the gains yesterday. We expect that to be different today. CAC 40 futures pointing to gains of around 30 points. Anna, what are you looking at?
Yeah, let's have a look at some of the individual stocks that could be on the move. And there were too many to choose from, frankly, today. So we went with these three. Let's go with Barclays first. What movement will we see there? Perhaps to the upside on the back of the investment banking performance, the guidance. That seems to have gone down pretty well with some of the commentary I've seen on the Bloomberg terminal today. BP also in focus, cancelling the buyback. But of course, there's a new CEO coming in. That was kind of expected, but we'll see if that one drops at the start of trade. The numbers themselves coming in pretty in line with estimates. And Kering in focus. Yes, a drop in Gucci sales of 10%, but that was widely anticipated, Guy.
Okay. Yep, we'll see what that does to the French market this morning. You also got to fold Astra into the London market. You've got Philips, plenty of other stocks out there as well. Right, here we go. London market, a battle between, you could argue, maybe BP and Astra and Barclays. The Barclays commentary, talk of acceleration in that business, quite interesting. Maybe a little bit more cautious when it comes to AstraZeneca. Pascal was here a little while ago. He says he doesn't see the revenue guide as being light. How will the market take it? We'll find out in just a second. These are the heavyweights on the London market. Stock 600 absolutely flat. Now remember, the back end of the session yesterday in the States, very, very flat. Very tight range for US equities at the back end of yesterday. The IBEX is out. It's up by 0.1%. The CAC is the one that I'm really waiting for this morning. Let's see how the CAC trades this morning. What is happening within the luxury space, critical to that market as well. Is there going to be a few jitters around the French banks as well this morning, or what is happening over at the Banque de France? I'm not sure there will be, but just keep an eye on that narrative as well. So the stock 600 absolutely flat. Nothing nothing to see here. I suspect within the market, we've got a lot of single stocks that are kind of balancing each other out. Tom, what are you seeing on the sector story?
So far on the sector story, consumer products, so luxury within the mix, of course, up 0.9%. That's leading the sectors in terms of the gains coming through right now. Energy, not surprising given there's a bit of pressure on oil prices today. Your biggest loser across the sectors, at least so far, down 0.6. That's now moved. It's insurers, interestingly, that are the biggest losers right now across your sectors, down 0.8%. So again, consumer products as a sector up 1.1%. The French CAC 40, let's check in, see if it's open. Not yet. We're not getting a pricing yet. To your point, FTSE 100 is currently flat. FTSE MIB over in Italy up just shy of 0.1%. But look on the index level, looking for direction. But then we do have the individual name stories, which are much more interesting, Anna.
Yeah, let's go to a few of those. So starting with the top of the gainers board, I suppose. But consumer products and services, you mentioned that's the best performing sector, being lifted by Tool, the company that makes those things that go up on top of cars. That company had earnings out this morning, and that stock is up by 10.4%. That's what I mean, and things that carry skis and bikes, and all the others. Insurance, yes, Tom, you mentioned that one is at the bottom, and it's kind of difficult to translate the weakness that we saw on the back of the insurers yesterday. These were insurance brokers in the States that dropped yesterday because of this new tool, Insurify. But I wonder if there is some read across from that into the London market. A couple of those that dropped yesterday in the US listed, but actually London-based insurance companies. So there's sort of already that theme translating across the Atlantic. But we do have then insurers to the bottom of the basket today, but BP also under pressure.
Astra's down, but not by much. Down by 0.2%, and actually it looks like the initial sell is coming kind of out of the stock fairly quickly. It is interesting, names like Allianz are under real pressure this morning. Down by circa 2%. Is it kind of is this a sell first, ask questions later? I don't know how this new piece of technology precisely. And that would feel like a continuation of what we saw last. Kering's just opened. Kering is up by 13%.
There we go. There we go.
Look at the Mayo. There you go, with the restructuring. He says there's still work to do, but he's got a track record of turning companies around.
And the market rose a lot last year on the back of that, but actually the stock's been losing a lot of that ground this year. I think it was up 25% in 2025 and lost some ground in January, but turning things around this morning. Let us put all of this together. We're joined by Max Ulia, who's European Equity and Cross-Asset Strategy Head at Deutsche Bank Research. Max, really nice to have you with us. I want to dive into one or two sectors here because I just think they're so interesting. We're seeing some weakness coming through in the insurance space this morning, and we were all following the story in the States yesterday around Insurify, and maybe this is the latest in a series of disruptions to stock market investors when we're trying to identify losers from AI. Last week it was legal services, it was software broadly, it was financial services, analytics. I wonder what you make of this, as Guy was saying earlier, sell first and ask questions later strategy from investors around those companies that could be punished by AI.
Good morning, and thanks for having me. I think it's kind of funny because just until recently the discussion was whether insurance is going to be one of the big winners from AI, so this is completely turning around. I think the discussion on software is premature, probably a few years out until we really see implications. So I think this theme is going to fade, right? Like we've seen some of these AI themes fade over the previous month, right? They create a lot of fear, and then a few months later we don't even remember the theme. So I don't think that that's really so relevant. However, on insurance generally, I'm pretty negative. It's the sector which we like least, because if you look at their valuations, then they're the highest they've ever been in that sector. So for insurance, apart from all this AI discussion, I'm really not a fan.
Okay, that's interesting. So, Max, we take those words. That's an interesting contribution to the conversation. So if you're looking for diversification, and I know that's one of the things we've talked a lot about on this programme and that comes through in your notes, diversification, is it all about Germany? You're sitting in Germany. Is it all about small caps in Germany? I mean, where's the best diversification strategy for global stocks right now?
That's a good point. So I'm sitting in Germany, as you can see in the back right now. I do think Germany has very good upside. The impulse, the stimulus, just started Q4 of last year. And we just see now really the first results. If you look at GDP growth in Germany, that was a lot better than expected. If you look at manufacturing order intake in Germany, that's a lot better than expected, up 8%. and investors don't yet give credit to Germany, right? So it's very early days to understand that. So people need more confirmation. But I think it's still astonishing that macro people haven't really stepped back into Germany. If you look at ETF flows, they're basically flat. If you look at single stock flows, they're actually improving, and people are looking for single companies within Germany, which is pretty helpful. And the ones that we like most, they're actually up 50% over the last 10 months. So things are happening, and Germany is really one of my favorite places within Europe. Very tactically, we actually don't recommend to move out of the US. Tactically, not short, longer term. We can discuss the longer term diversification themes in a second. Short term, if you look at earnings, they're just stellar in the US. If you look at GDP growth in the US, short term, it's just stellar. So very short term, we actually like the US better. But then all the risks that are associated with this growth are very much US-centric, right? You discussed the AI thing. We've seen what happened in software last week in the US. Government interventions, you mentioned those. So there's a lot of stuff that's making us nervous about the long-term outlook for the US, and we see sharper drawdowns in the US compared to Europe, especially Germany. So if you want to alleviate all of those risks, go to Germany or go to Europe. Or go to sectors like quality that you've mentioned just a second ago, where valuations are kind of fair. We actually don't expect them to benefit a lot from the cyclical uptick that we have, but they're all pretty cheap. And we do see those sectors, staples, telcos, and discretionary, we see those really improving and doing best when markets are having a hard time. So for diversification, I would probably say Europe over US. Tactically, for absolute upside, US over Europe. And for diversification, go a little bit more into quality, which is by now really, really cheap.
The US is delivering a pretty big fiscal push right now. Germany's doing the same thing, but the US is as well. Can I just come back to this sort of short-term, long-term view? When do you want to get out of the United States? What, kind of just tactically, can you just kind of talk me through how you see the next 6 months working? Because timing here could be really interesting.
Yeah, so if you compare the two, it's actually, can hardly compare it. For example, in Germany, we have this accelerated depreciation. So you can write off 30% of your capex in year one, another 30 year two, another 30 year three, which is a big improvement from what we've had in the last 20 years. Right? So that's really something big. We see the fiscal coming in. By the way, the fiscal in Germany is purely on investing and not on social spending, so also very good, but it's a plan for the next 10 years, so it's coming very, very slowly. In the US, we have this affordability push, which is very much focused on achieving better affordability and high growth, in our view, especially until the midterms, and a lot more aggressive depreciation rules. If you compare depreciation rules in the US to Germany, they can depreciate capex 100% partially in year one. So it's a bigger impulse short term, but growing at 4-point-something% as we currently see it in the US in GDP now numbers, for example, is probably not sustainable, especially if that means that you run a deficit of 7% to compare it with Germany, for example, of 3%. Okay. Right? And debt to GDP.
Okay, Max, so what do I do here? Is the midterms the target? Do I stay long the US until the midterms and then I expect the fiscal impulse to fade? Just give me, what does this year look like and how do I time my exit from the US if that's the thing I want to be doing?
I would very slowly fade out. This preference for Europe versus US from a risk-return perspective is really something strategic, where we think that people will be looking for alternatives. Tactically, the US is the place. Mini timing, micro timing really depends on what happens, right? For now, I would be long US. With the earnings season so strong, I would be long US, potentially for the next 3 to 6 months. And then if you see that this growth is potentially not as sustainable as we are currently thinking, and if you see the earnings pick up that we expect, for example, for Europe, we expect earnings to grow by 10 to 12%. Compare that to 0 last year, then the growth gap moves to only 5% in earnings relative Europe versus US versus 10% last year, right? So the gap is shrinking, and this widening or shrinking in gap is really what makes me tactically more interested in Europe versus US. Right now, US is growing faster. I think H2 of this year, potentially Europe will be outpacing or at least picking up versus the US, and then the growth gap shrinks. So H2, I think, is the better place for Europe versus US.
H2 is the better place for Europe versus the US. The president, of course, wants to see 15% growth in the US. Max, good morning. We've got a redhead crossing the terminal right now. Alphabet kicking off this debut sterling bond sale with a $100 100-year note. What does Alphabet look like in 100 years? I don't know. But Max, my question for you is, do we start to worry about free cash flow at some of these Mag 7 and mega cap tech names? How are you thinking about the reliance on debt as we build out CapEx and data centers?
I think the very easy answer is here, right? You need to grow your CapEx relative to your earnings growth. And I think the market was actually pretty smart in differentiating amongst companies within the Mag 7 of which ones can do this and which ones can't. And right, basically until 12 months ago, Mag 7 were going in one direction. This year you saw massive divergence in performance. And some of the companies that have been growing earnings with CapEx, they are the beneficiaries. If you can't manage to do that, you are losing out. So that's really the big question. And I don't think that investors are willing to give credit to future earnings if you have too high CapEx right now. I think if, for example, the Alphabet example, I'm not a single stock analyst, but that might, if that's coming with very strong earnings growth, that's actually okay by markets. And one more thing, tech has been underperforming massively. It's now at the lower end of the corridor with relative performance. I think a lot is priced in. And don't forget that they could cut on CapEx if they want it. If you're a company that has high CapEx and has been punished, maybe next quarter you will revisit and rethink and cut CapEx, and the market will actually appreciate what you are doing. So I'm a little bit less worried about that theme than many others.
Okay, I want to end it with your very bullish view on Europe and Germany. You've mentioned it a few times, Max. You're feeling good about getting exposure to particularly to German stocks. What level of the euro dollar becomes a concern for that view on the earnings story? We're closing in on 120.
Yeah, so it will be a concern for Q4 earnings. It's roughly shaping off 2 to 3% of Q4 earnings because the dollar was 10% weaker Q4 versus Q4 24. If we go to 125, that really doesn't move the needle. Q1, again, we have this year-over-year comparison, which is a little bit harmful. But don't forget that for the last 6 months, the dollar has been basically trading flat. And I'm a little bit surprised how much people get worried about the dollar and the implications for European earnings, because it's just one factor of many. Even if we move to 130, I don't think that this will really be harmful for euro earnings. Maybe one big last closing statement from me. If you really zoom out and you think, how did the dollar move from 2009 to 2024? That's when US equities massively outperformed European equities. Then it actually went from 150 to parity. And we are now going in the other direction. And guess what that implies? We think that just means that there's more demand for European assets, European equities, European bonds, etc. And this, in our view, longer term, without the technicals, is actually something pretty interesting and supportive for the euro and the eurozone.
Nice point to finish on. Max, great to catch up. Always a pleasure. Thank you very much. Max Julia, European equity and cross-asset strategist, head at Deutsche Bank Research. Core 6 looks like this. Let's see what the ripple effect out of Kering is into LVMH. It is, as you can see, up quite nicely. I'm going to get to luxury in just a moment. Having a very good morning. ASML is down. Chips generally actually are under a little bit of pressure. Defence is also under a little bit of pressure as well. But the luxury story may be the standout story this morning. Hence why I think Chloe Melly might be starting there.
Yeah, absolutely. Good morning, Guy. Kering is up very strongly this morning, almost 13%, and is driving up the rest of that luxury sector with green across the screen there. So for Kering, Gucci sales came in actually within expectations. They dropped about 10% in the fourth quarter, but that was in line. And therefore, for investors, that'll be seen as a sign that the turnaround under the new CEO, Luca is progressing well, is making its way. And so this is going to be seen as reassuring and as driving up the rest of that sector, which is good after the LVMH results disappointed a couple of weeks ago. Moving on to Philips, which is also up this morning. The medical technology firm is up almost 10%, and that is after setting new medium-term targets and saying that the performance is improving thanks to new products, to a streamlining of the business, and that is helping to mitigate some of the tariff uncertainty it's dealing with, some of the weakness in China is dealing with as well. And so we are up very strongly for Philips this morning. We are also in the green for Barclays. We have got investment banking. Oh, it's actually down now, but it was up earlier. Investment banking revenue that had the beat estimates and also a plan to return the capital to shareholders of more than 15 billion pounds by 2028. And so that was taken when the market opened as quite positive, but now it's paring back some of those gains. For BP, we're also in the red this morning. It is down about 4% after pausing buybacks and raising its target for cost cuts. It's obviously undergoing this big turnaround, this refocus on oil and gas, and this pausing of buybacks is part of that. But the new CEO is coming in later this year in April, and she's got a big task ahead of her. And finally, let's end on tyre makers, and we have got Continental and Michelin down this morning. This is some read across from Goodyear over in the US, which had some disappointing results, and so this doesn't bode too well for those tyre makers here in Europe.
OK, our equities reporter Chloe Melly on some of the stocks on the move this morning. Chloe, thank you. Coming up, BP attempts to strengthen its balance sheet, halting share buybacks as the pressure on the British energy giant mounts. We'll bring you more details and analysis. Stay with us. This is Bloomberg.
We'll be 19, 20 minutes into the session. BP's down 4.3%, halting its share buyback, raising its target to cut costs. This amidst rising pressure, of course, on the British energy giant to deliver a turnaround. Let's speak to Alaric Nightingale, who leads our EMEA oil trading coverage. Good morning. Market doesn't like this. Market doesn't like the buyback story. What else is going on?
The market doesn't like the buyback story. It wasn't a slam dunk. There was a definite possibility that this would happen, but it has happened. And so, for those people who were kind of still holding hope that they would retain it, it's been a surprise, I suppose. At the same time, they're taking their medicine. They are sorting out the balance sheet. They are getting things into a better position, maybe if they want to start to try and put some capex into upstream later on. So yes, it's bad news. Yes, there was a kind of a surprise element to it, but I think...
But look below the surface and actually the medicine's being taken.
Yeah.
And the medicine's being taken in the form of some cost cutting as well, even though we're still waiting for the new CEO to come in, aren't we? So what do we take away from the cost cutting story?
Well, the cost cutting, actually, there's an element of that that's to do with Castrol, which was a known thing. So if you take that out, actually the cost cutting, I would say, hasn't been that severe yet. So maybe that is not a great thing for them. Maybe that isn't some medicine that's been fully taken.
Maybe intentional to leave something for the new
CEO
to do.
At the same time, I think there's been maybe there's a clearing of the decks with the buyback cuts. But there's still work to be done there for sure.
Meg O'Neill, the new CEO, the incoming CEO, she takes over when?
April.
OK, so we watch for that. Clearing the decks ahead of Meg O'Neill taking over as the CEO of BP. Alaric, thank you very much indeed, of course, in terms of what we've been seeing from BP. And as we've been mentioning, the shares are down 4.2%. Let's switch focus to a different stock story in the luxury space. Kering shares surging as its full-year 2025 results show more houses transitioning to growth, including Balenciaga. Let's bring in Bloomberg opinion columnist Andrea Felsted. Andrea, what is leading to the upside for the stock price? Why is there so much enthusiasm for Kering on the back of these earnings?
It seems that Gucci wasn't quite as bad as feared. The results weren't quite as bad as feared, full stop. And they were a little bit more optimistic on the Chinese cluster, which is obviously one of the key drivers of luxury this year.
Are cars different than handbags?
Definitely, yes. And this is a key thing. So it's all about, these results, they're interesting. They're probably a bit backward looking. What we've got to look forward to is this Capital Markets Day in April, where he's going to lay out his strategic vision. And, he's done a great job so far. He's come in and hit the low hanging fruit. He sold the beauty business to L'Oreal, shook up the Gucci management, delayed the deal to buy more of Valentino. He did all those easy wins very quickly, and the share price had a great run. Now he's got to go through the next stage, which is really all about turning around Gucci. And he's got, he's also cut debt, which is very good. He's talking about restructuring the organisation. Now, the key thing is he's got to do this while hugging the creatives, because, he said creativity is our focus.
Yeah.
But,
I'm picturing this.
You can't, cut loads of costs, take away the marketing budget, particularly when you've got LVMH on the block, which has got, massively strong balance sheet, can shout louder than anybody else. So you've got to do all this, hard corporate stuff while creating beautiful products, stoking desirability. And he's talking about that, but let's see if he can do it.
Does he speak fashion, Andrea? It's such a different industry.
From what I heard from him this morning, he's saying quite a lot of the right things about stoking desirability, creativity is our core. He was saying all the right things. Also talking about, maybe consolidating the store base into, getting rid of smaller stores, better larger stores, which is something that Inditex Zara has done very well. So he's all saying all the right things. Let's see what.
Should we mention at this point who he and him is? I don't know. Have we mentioned? Yeah, look. There we go.
Came from the car industry.
Yes, the former CEO of Renault. No, I'm aware of this. I'm just flagging for our viewers.
I know you are.
Without mentioning
but I see it's interesting. Handbags and cars are creative things. They're beautiful things.
They are.
I don't
You're
see
a big
why
fan of the new Renault?
The Renault 5 looks very cool, the new one. Looks like the old one, which is why I think it looks cool.
Fully electric?
Yeah. There are other EVs available, but this one looks quite nice.
I used to have an old Renault 5. I think it was a cut and shut.
Yeah, wow, okay.
Half blue, half red.
That goes back. But creativity, you've got to hug a creative. I don't know quite whether he's ready to do that or not.
What does that look like, hugging a creative? And ultimately what happened, is Gucci survive? Can you revive Gucci given the travails of that brand?
Well, I think hugging the creatives is really giving them the support and the resources to to create the products and also to market and to get their voice across. It's about who can shout the loudest, who can be at the forefront of consumers' minds. Yeah. You've got to do that while tackling the organising the debt. And on the Gucci point. Yeah. Demna Gvasalia has he hasn't shown his full collection yet. He's going to.
He's the designer, is he?
He's the designer, new creative director. He's going to show his collection later this month in Milan. We had a bit of a teaser. It seems to be doing quite well so far. So we're just going to have to.
So he's feeling loved.
He's feeling loved. The signs are good, but there's a long way to go. Whether it will actually sell, whether people will actually buy, is another question.
I suspect Guy Johnson may be in the front rows at Milan for that.
For the car show.
For the car show, yeah. That's definitely the case. Andrea, we're watching lots of sporting events at the moment, and I'm wondering who's doing well out of these. I've seen all kinds of labels on the slopes over at the Winter Olympics. There was the Super Bowl, and I know you were writing about Zara yesterday and how you think they've done pretty well with the push into the US there. Who's making the right moves around sport?
LVMH has been the biggest driver into sport. It really has they did the Olympics a couple of years ago. They've done the F1 sponsorship. They are really, really driving into it. So they've got I think they've really got the edge there. But everybody will get in. Ralph Lauren, dresses the US team.
Yeah. So. The biggest shock here is that Anna's watching sport. Let's just point.
It's a very big deal.
For the fashion. Bloomberg opinion columnist Andrea Felser, thank you very much indeed. Coming up, we're going to check in on the European bank earnings story. We've got the the co-head over at RBC Capital Markets joining us next to give us a view. This is Bloomberg.
Good morning, this is the opening trade. We are 30 minutes into the Tuesday session. The benchmark, you're down about 0.1% when it comes to the European Stocks 600, with the context, of course, that you had fresh record highs yesterday. The DAX is down 33 points. The CAC going over in France, supported by the luxury space. Very strong moves higher in Kering. We'll be discussing that. Up 0.4% then on the French benchmark. Here in the UK, the FTSE 100 dropping 43 points, down 0.4%. You've got the insurers under pressure. Guy has some details.
Yeah, we'll come to that in just a second. Let's just talk about the market internals before we get there, Tom. Very balanced market this morning in terms of winners and losers. You got 303 up, 288 down in the stock 600. So basically 1 for 1. Volumes picked up a little bit. It was a little quiet yesterday. We picked up a little bit. Let's start with the upside. The gainers this morning. Kering is the real driver here in terms of the percentage performance. It's up by 12.63% on the back of what has been said this morning. We were just talking about it. But over the last few minutes, the points gainer has become AstraZeneca. It is up by 1.35%. That was interesting. We were talking to Pascal Soriot a little earlier on in the programme, right at the beginning of the programme, talking about the results that they've delivered. The call then was actually that Astra was going to open down, and it was on the back of kind of what was seen as being cautious revenue guidance. Seems that he pushed back on that very strongly. It seems the market is taking a slightly more positive picture as well. AstraZeneca now up by 1.1%. Philips is also a real standout story on the upside. So 3 nice stocks to the upside in terms of what we're seeing. The downside, though, we're seeing that balanced out. BP is down by 4.35% on the back of its numbers, the buyback being cut. Standard Chartered, on the back of losing its CFO, is down by 4.7%. The insurance sector is under pressure. Now, this came out of the United States yesterday. This is AI-related and the latest AI threat to a particular sector. And the insurance sector got hit hard in the States yesterday. Allianz is maybe taking it on the chin as a result of that this morning. It is down by 2%, Anna.
Let's get an update on some of the other stories that we are tracking this morning, Guy. Emails released by the US Department of Justice show convicted paedophile Jeffrey Epstein and DP World Chairman Sultan Ahmed bin Sulayem swapped messages for more than a decade after Epstein's jail sentence in 2008. The correspondence shows the men exchanged contacts in business and politics, attempted to broker deals for one another, and made explicit references to sexual encounters. Neither bin Sulayem nor DP World have responded to requests for comment. TSMC's January sales grew at their fastest clip in months, a sign of sustained global AI spending, even as concerns persist about an industry bubble. The chipmaker, which supplies the likes of Apple and Nvidia, reported a 37% rise in January revenue, above the 30% revenue growth TSMC expects for the full year. And so Standard Chartered CFO Diego De Giorgi has resigned to take up a role with Apollo. De Giorgi joined the lender in 2023 and was seen as one of the frontrunners to eventually replace longtime CEO Bill Winters. He will move to Apollo as a partner and head of Europe and Middle East and Africa. Standard Chartered says that the deputy CFO, Peter Burrell, will replace De Giorgi on an interim basis as the firm seeks a permanent replacement. Tom.
Anna, thank you very much indeed. Let's stay on the banking space then. Another day, of course, another bank promising to return money to shareholders. This time it's Barclays, vowing to hand over at least £15 billion, in terms of its return of cash by 2028. That's as the British lender's fourth quarter earnings beat estimates. It follows a similar announcement from UniCredit to return €50 billion to shareholders. Joining us now is Anke Reingen, co-head of Global Financials Research at European Banks and RBC Capital Markets. Anke, good morning. Thanks for joining us. Obviously, European banks have performed very well in the last, at least in the last 12 months. The earnings coming through, return of cash to shareholders. What for you is standing out with your finger on the pulse of the European banking space? How match fit are these lenders as we look into the second half of 2026?
Yeah, so the results, they were all really quite, as you said, reassuring in terms of top-line momentum, good operating leverage, capital distributions. The story with Q4 results is always what's the outlook, to your point.
Yeah.
And I mean, I guess we have a number of trends. Top line, net interest income, we see some loan growth accelerating. Fees have been one of the key drivers. Obviously, we're looking here for investment banking, pipeline being building up. But as in the past, we have seen, well, fees might be not as strong, but trading has offset this. So the trade-off, I think one of the themes is as well cost control. Clearly, everyone is talking about investments. How do you offset them with further improvements in operating leverage? That's clearly been a topic across different spaces. So I think that's clearly important. Capital management, as you mentioned. We have a relatively high distribution. How does it play also with regulatory eases across different regions? Does the US softening impact competitive dynamics within Europe? But also, as we've seen recently, has a new dynamic in capital management come up. As share prices have increased, buybacks have become less value creative versus organic growth or bolt-on acquisitions. So as we've seen, there are new topics emerging, and what's the right balance between the different measures? So I think the outlook is clearly key. I think the sector is well positioned. Expectations have moved up as well, so we need to see how that all squares. Overall, probably positive on the sector, but given where share prices have moved, probably a bit more selective.
There's a lot to unpack there. So I'll zero in on the mergers and the cross-border potential acquisition story, because we're thinking about Commerzbank as well with their earnings, and of course the build-out of the stake there by UniCredit. What for you is going to be central in terms of what Bettina Orlopp is going to be walking through for the rest of this year? How does the Commerzbank story change in light of all the focus and scrutiny of that lender last year?
Yeah, I think they have, obviously, Commerzbank has made lots of progress in terms of operating efficiency, top-line growth. So I think we're going to look for, does that top-line momentum continue given the rate environment? I think there is room to do better, but also the diversification with fee income. And then, obviously, how does it square? They've made lots of progress on cost efficiency. Is there a need to invest in the near term to drive that forward? I think that's one of the things they're going to look for tomorrow in terms of the cost trends for the next quarter. Capital management is another theme. They're already at 100% payout ratio. Can this go higher? or do they look for organic and M&A growth? I think the ROE has potential to move up. The target of 15% was announced a year ago, and since then operating trends have been better. So I think all these factors, but obviously a big theme is Germany. So do we see an evidence of loan growth picking up as the German economy sees the catalyst coming through? I think it's a bit too early, but clearly there's a hope in the second half.
Stocks up nearly 90%. 90% in the last year. Can that continue?
I mean, I suppose there's a few stocks in the sector that have.
Okay, so SocGen's done 112, so it's not the only one. So there's been some incredible. I guess the wider point is there's been some incredible performances.
No. I mean, I don't think 100% is repeatable.
Okay.
I think expectations have moved up as well. So every quarter is about catching up. Ratings move up, estimates move up. I think it all depends on can we continue with the operating leverage, and is there more they can do on capital management. 100% I don't think is repeatable. Further ROE improvement and re-rating, yes.
What's the difference? It's amazing. So I think over the last 12 months, every single bank in the banking sector in Europe is up. But the difference in performance is absolutely stunning. Some are up 112%, some are up 6%. What is the difference here? Are the laggards going to catch up? They're going to be taken over. Kind of what happens here in terms of that spread in performance?
So I guess one thing of the driver point for Commerzbank is the German factor last year. So that's definitely helped Commerzbank and Deutsche. I think 2025 was a lot about which bank are not yet at the cost of equity return. Those stocks will do better. And if you go down the list of the stocks that have done well, that's mostly the ones that are perceived to close the gap in terms of return. Now we're at that level. I think it's more about executing on the plans to drive. And I guess GDP upgrades are one of the key drivers of bank stocks. So far as only 1% GDP growth. So anything that variates it would drive the sector higher.
Yeah, and a bit of M&A expectation and speculation helps, doesn't it? What about the German growth story then, Anke? Because we spoke to an analyst earlier who was saying the second half of the year for stock exposure is a good time to sort of make it to get the benefits of the fiscal push in Germany. What about the banking sector? You mentioned that growth is a big thing for the banking sector and they respond to it. So what's the timing? What are you expecting to see from this huge fiscal push in Germany and how that goes out into the banking space?
So far there were relatively little signs. I mean, retail loan growth has picked up as rates are stabilized and mortgage growth has accelerated. On the corporates, there's very little signs yet. So I think we're really waiting for...
little signs of enthusiasm that means they go out, take risks, take out loans.
Yes. So there's relatively little. Like Commerzbank had a bit in Q3, but let's see what Q4 brings. So I think we definitely in the second half need that GDP accelerated and investment-driven corporate-led loan growth. I mean, some other banks would have quite... not aggressive, but optimistic growth targets in corporate banking. So I think that needs to be coming through. And I mean, we're in the camp that we'll see the momentum in the second half, and I hope that plays through for the banking sector and the wider space.
Okay, Anke, thank you very much. Thanks for joining us. Anke Reingen, Global Financials Research and European Banks Co-Head at RBC Capital Markets. Sticking with banking, we spoke to the Barclays CEO about the UK economy and the ideal business environment. That was a little bit earlier.
What we want from all governments in the UK is a commitment to growth and productivity. We think the markets look for stability in financial policy and economic policy, and you can see that in the way the markets are trading. And so what we look for is stability, predictability, and policies that drive growth and support business and industry, and from my point of view, the financial industry.
That conversation, of course, as Keir Starmer shored up his position as UK Prime Minister after securing public support from his cabinet and delivering a defiant speech to his MPs. However, his position remains fragile given the storm over his appointment of Peter Mandelson as US ambassador and the latter's links to Jeffrey Epstein. For more, let's speak to Daybreak anchor Lizzie Burden, who, of course, follows this story very closely. Lizzie, how on earth, how did he survive yesterday? Just after lunchtime, it looked as if the story might not end that way.
I know I was packing my bags for Downing Street at this point yesterday, but if we recall, you had two Starmer top aides quitting, then you had the leader of Labour in Scotland, Anna Sarwar, calling for Starmer to quit, but then Starmer gives this barnstorming speech in Parliament to his own MPs, and then you have every single member of his cabinet coming out to back him. Why? Well, the reason that they're giving in public is that everyone's had a come-to-Jesus moment and realised that it's only been 18 months since Starmer got this landslide election victory. We should give him a chance. behind the scenes, when you talk to analysts, it's because none of the runners and riders to replace Starmer have got their house in order, and they still need to get their campaigns ready. So ultimately yesterday you did see gilts pairing their declines. That pound-euro drop came back a bit. And one MP was joking by the end of the day, Starmer's in a better position than he started it because now he's got his cabinet behind him.
Don't we just have to wait till May? Isn't this... why would you want to be running for Prime Minister before the May elections when Labour looks like they're going to get hit hard?
Because then you'll have a reason, right? You don't want to stab the Prime Minister in the back before there is...
Well, you want him to take the hit, not...
Exactly. That is what analysts are saying. Before that, don't forget, you've got the Gorton and Denton by-election in Manchester. And interestingly, even though nationally you've got Reform leading in the polls, I was speaking to a pollster earlier who was saying it's the Greens to lose that by-election. But the crunch moment, he said, was the May election, as you suggest, Guy. And after that, it's difficult times for Starmer. Interestingly, from economists, they're saying if Starmer could just cling on for a few more months, you could have inflation back at 2%, you could have some interest rate cuts in the bag, you could have the economy growing again.
2% inflation is the forecast from the BOE for the second half of this year. 2% inflation, the housing market is picking up a bit.
That's target, by the way.
Productivity is set to improve. Target, we're not there yet. We're not there yet. More rate cuts potentially to come from the BOE.
Yeah.
Is any of that going to move the dial for May? I mean, we're just assuming, of course, on the polling that he's going to get a shellacking in May. But does any of that economic momentum feed through? And
I think you have to get through the political uncertainty before that, and that is clearly not what is the top line of the story at the moment when it comes to the pressure on.
So who's waiting the wings? Who is best positioned?
Just remind
us on the runners and riders, and whether or not it's down to HMRC to clear up the tax. And Angela Rayner,
I knew you were reading her. Well, you've also got Wes Streeting, of course, Health Secretary, very charismatic, but still proving his way. I'll give you
he was a Mandelson.
Yeah,
he was a Peter Mandelson.
Distancing himself from Peter
Mandelson.
Yeah.
But I'll give you a candidate who's also on our runners and riders list who you may not have heard of, Al Carnes, Armed Forces. Yeah, one to watch. Armed
Forces.
But this is also the point we were making yesterday, that the fact that the list is growing and growing. I mean, you'd expect that if there's going to be a leadership contest, but it is indicative of the fact that there isn't such a strong character that clearly leads.
Exactly.
Because if that were the case, then those other contenders might be less willing to come forward and sort of speak about their ambitions. But
Lizzie Burden started by saying I was packing my bags for Downing Street, so I have an image now of Prime Minister Burden in my mind.
Just waiting for the call, Tom.
There we go. You heard it here first. Lizzie Burden, thank you very much.
On the list.
Daybreak anchor, of course, and UK politics correspondent as well. Coming up, maybe a humanoid robot would be better placed in Downing Street, question mark. How much have Hyundai shares risen, there is a segue to this, since the debut of the Atlas humanoid robot? We'll give you the answer when we come back. This is Bloomberg. Welcome back. Now, before the break, we asked how much have Hyundai shares risen since the debut of the Atlas humanoid robot? A niche question, to be fair, but the answer is 60%, and it's a broader story that we're highlighting here. The stock has been on a tear since Atlas was unveiled at the CES Technology Conference in Vegas last month. The share's got another boost in trading today. That's after the automaker's robotics unit released a video, shown here, showing the robot executing a cartwheel and backflip, highlighting its dexterity and life-like movement, having been trained on videos of Anna Edwards and her gymnastic skills. Anna.
That's absolutely what happened right there. I give it a perfect 10, and I like that we've lingered on the video there. Oh, we did for a moment, because all the outtakes are brilliant. All the learning experience that's been going on behind the scenes before, there we go, there it is, falling flat on its face. I think that was a bit slippery, that bit, and some of it looks really brutal. Yeah, not nice. But I feel like the fully trained thing that we saw initially, he's good enough to almost start work in my house fairly shortly.
This is the point. It's A, it's learned, and B, it looks like it's ready for mass production. Like, how quickly does something like that end up doing your cleaning? Yep.
around the house.
Around the hoovering, doing the hoovering, vacuuming.
Yeah. Or in any other, or in a factory somewhere, carrying things, or on a battlefield, as one of our producers is mentioning.
That's probably the more disturbing element of all of this. Let's go to the easier to maybe comprehend initially story around what is happening elsewhere in tech. Alphabet selling sterling and Swiss franc denominated bonds for the first time. There's an ultra rare issue of a 100-year note in sterling. This after a bumper 20 billion in sales of US dollar bonds. Joining us now on this is Matt Bloxham of Bloomberg Intelligence. Why are they financing AI with debt when they've got cash flow as strong as they have, is my question.
Because I guess any
good... Because they can?
Yeah, exactly, because they can, and any good corporate treasury department would look to kind of tap into every source of cash you can. I mean, as you said, they've got about 60 billion of long-term debt at the end of 2025. They're going to generate about $200 billion of cash in the next year. Their capex is as much as 185 billion. They've got cash on hand of 126 billion. So, they're not in a difficult spot by any stretch of the imagination, but it makes sense to give yourselves lots of liquidity. Who knows, maybe that capex number is going to go up again. We'll wait and see. You've got some aside for a rainy day, and the spreads were incredibly tight. So I think when the bond market is desperate for your credit, you take advantage of it. And I think what they issued $20 billion of US denominated debt, and they had something like $100 billion of demand, and so the kind of spreads were pretty tight. So it makes absolute sense to take the opportunity whilst it's there.
And we were thinking about how it's kind of crazy to borrow for 100 years in the tech industry.
Yes.
When you look back 100 years, what tech looked like.
Yeah.
And now what tech looks like and what it'll look like in another 100 years, Matt. But clearly there's some demand for it. The broader tech theme right now, I know you're looking at as we continue to be through the earnings story, we've taken our eye off tariffs, but we've got a possible reprieve for the tech sector on the tariffs front.
Yeah, that's right. It's an interesting story here that potentially big US tech, so the likes of Google and Meta, Amazon, will be reprieved on semiconductor tariffs, but it's tied to commitments from TSMC, the main manufacturer of chips for the likes of NVIDIA and for Apple smartphones, that they will deliver on investments into the US, essentially replicating their Taiwanese-based manufacturing into the US. And they've been talking about this for a long time. TSMC's already kind of got plans that direction. But I guess it's a breath of fresh air or kind of a sigh of relief for the kind of US tech giants, but also going to obviously help NVIDIA and TSMC if their biggest customers in their biggest market aren't having to kind of pay over the odds for that technology.
Okay, Matt, great to see you. Thanks for stopping by. Fascinating things happening. It's interesting to see what happened with the tech sector yesterday, certainly catching a pretty strong bid. Is that going to be something that is going to be sustainable throughout the rest of the session? Matt Bloxham, thank you.
Here's what else to be thinking about today. The International Energy Week begins, and at 1:30 p.m. UK time. This is important. You see US retail sales coming out. We'll see. There's a view that they're going to tick up pretty strongly on a big week, of course, for data, with inflation data and jobs data delayed, of course, out later this week as well, starting tomorrow. But we get retail sales later today. 5 p.m. UK time. It's the ECB's Schnabel, typically on the hawkish end of the spectrum speaking. And on the earnings front, stateside, Ford, Duke Energy and Spotify, Anna.
So some corporate earnings to focus on. Now, as equities extend a rally to all-time highs globally, thanks to a rebound yesterday in US tech stocks, the Asian equity session looked pretty strong. The dollar facing renewed pressure. European stocks are pretty flat right now. US futures flat, mixed. For more, let's talk to Skylar Montgomery-Koning from our Markets Live team, who's with us on set this morning. Skylar, the global sort of outlook for stocks, well, yesterday was really rosy, wasn't it? New all-time highs. But now, do we pause waiting for the US data? Is that the next big thing on our agenda?
I mean, I think it certainly is. I think from an economic perspective, we're very much in an environment where good news is good news. So if we have a strong jobs report, then that'll be seen as positive for US equities. I will also say that expectations, particularly heading into the jobs report, have been dampened quite significantly. So you had that from the asset comments yesterday, but also some of the weak data we got last week. I will say that data like ADP doesn't have a very good correlation with NFP, so I wouldn't see a big read-through from one to the other. But what you have seen is that the whisper number has come down quite significantly. So it's at something like 47,000, which is 20,000 below consensus estimate. So that means risks are very much skewed to a stronger print supporting equities.
Why is good news good news? Doesn't it tell the Fed not to cut rates? Or are we just assuming that the Fed is going to cut rates because Trump wants 15% growth and Warsh has been tasked to deliver it?
I think that's definitely part of it. I also think that sometimes markets are a little short-sighted in that any possible cuts not coming until the second half of the year.
Yeah.
So it's not something we're focusing on right now. We don't know exactly what a Warsh Fed chair would look like.
Yeah.
So we don't know how to price that in, what to do on it. We are pretty confident that we'll get 1 or 2 cuts. And so that's just kind of a firm pricing that stayed where it is with respect to how it feeds into equity markets.
We're going to get 15% growth in the US, though, aren't we? According to President Trump. Speaking of Fox News, look, as we were discussing the editorial meeting, and Guy, you were zeroing in on the pressure on Warsh, the expected incoming Fed governor, is intense. I mean, how do we square the two in terms of the rate expectations from the Fed and a red-hot US economy?
Yeah, I mean, I think this is what's very troubling, and maybe you need to think about him as being a more orthodox candidate. You need to think about this idea that it is still a board of governors, so you are still voting, and something even like balance sheet normalization needs to be voted on by the board as a whole. So if you do have data coming in hot against inflation that's very, very high, or rising as the growth is coming in stronger, then that means that you will likely have to have a Fed that reacts to that, especially if it's a more orthodox candidate, especially because you have every member voting. So very much data dependent. I just don't think it's something we focus on really in the next month.
AI capex is inflationary, right? $650 billion. Is that the right way to think about it, or is it deflationary at the other end in terms of upstream and what it does to productivity?
Yeah, I mean, I think this is something that we're really much debating. A kind of real-life example that I like to point to in terms of how AI impacts the economy and tech generally is you think about US ATMs. When ATMs were first introduced, there was this big worry that you could have no bank tellers anymore, but you didn't actually see the number of bank tellers decline. It actually increased, and they upscaled, and they started dealing with clients more, and you had higher profit margins, and that was actually inflationary and pro-growth. So yes, you do get some displacement, certainly from a jobs perspective, but it's also positive for growth.
That's the win-win. That's the win-win scenario.
And the longer-term story looks a little bit different for those who work in banks, maybe. But your point's well made. Skylar, thank you very much. Skylar Montgomery-Goning from our Markets Live team. European equity markets fading those earlier gains, really, aren't we? The earnings story is going down well in some cases, but stocks now just pretty
quite balanced in terms of what we're seeing, one for one almost in terms of the performance on the upside and the downside. But the US market came up quite strongly in the first few hours yesterday and then went kind of very sharply sideways. And now we've got futures a little softer. Crypto also soft this morning. Is that a little lead indicator maybe to watch out for?
Another important CEO on the earnings front coming up at 9 a.m. Andrea Orcel, of course, of UniCredit. So stay tuned for that on The Pulse. That is next. This is Bloomberg.